Every Friday afternoon, the global financial machine does something strange. It simply stops. Banks lock their doors, stock exchanges freeze, and the movement of capital grinds to a halt until Monday morning. But capital never actually sleeps. While legacy systems go dark, a parallel network takes over, moving billions of dollars across borders without a single bank teller or clearinghouse involved. This split-screen comparison shows the scale of that shadow activity. On the left is Visa, averaging $40 billion in daily volume. On the right is the weekend stablecoin market, transferring roughly $76 billion, precisely when traditional markets are closed. For years, digital dollars were viewed strictly as trading chips. They served as a digital waiting room where crypto speculators parked their cash between trades. That holding pattern is over. These digital assets have moved beyond the exchange ecosystem and are now being used to execute the core, everyday tasks of global commerce. This continuous weekend volume highlights a shift toward a financial system that operates without the constraints of legacy business hours. To understand why this is happening, we have to look away from the billions and focus on the individual. For millions of people globally, holding local paper currency means watching their wealth evaporate as it steadily loses its purchasing power. Right now, 87% of the world's fiat currencies trade at a premium against stablecoins. In hyperinflation economies, citizens pay an average premium of 62% to acquire digital dollars, desperate to abandon their national money. Paying a massive markup upfront sounds irrational until you do the math. When local currency is in freefall, absorbing that 62% penalty is the only reliable way to lock in the remaining value of your savings. At the micro level, acquiring digital dollars is a necessary act of self-preservation against broken national systems. Protecting value is only the first step. Consumers are now actively growing their money. Binance manages yield at an unprecedented scale, serving over 14 million everyday holders. By putting stable assets to work, Binance has distributed roughly $1.2 billion in yield. Eligible holders earn up to 8.8 times what legacy banks pay through the national savings rate. Unlike a traditional savings account or a certificate of deposit, this digital money isn't locked away. It remains completely liquid. That liquidity is driving an explosion in everyday utility, pushing stablecoin payment volume up 114%. This growth comes from ordinary life. The median merchant transaction sits right at $18. For millions, achieving superior yield on an instantly spendable balance makes the traditional checking and savings account model obsolete. Zooming out, the largest pools of capital on Earth face a structural problem. Global institutional capital operates across borders, requiring deep, uninterrupted liquidity. The traditional finance perpetuals market crossed $1.1 trillion in aggregate volume. Institutional traders use stablecoins to bridge the weekend gap. While traditional markets flatline, the blockchain stays open. Traditional finance is actively relying on stablecoin rails to maintain continuous global operations. Managing trillions of dollars across citizens fighting inflation, consumers seeking yield, and institutions trading over the weekend requires reliable infrastructure. This chart shows the market share of custody, demonstrating how the demand for security results in significant centralization. Users have chosen to leave approximately $53 billion in stablecoin reserves on Binance, capturing 57% of the market share. Moving that capital requires extreme transactional velocity. The decentralized BNB chain processes roughly 10 million stablecoin transactions every single day to keep this ecosystem running. The barrier between the digital asset world and traditional finance is thinning as institutional capital relies on these tokens for 24/7 liquidity. By settling massive capital on-chain every hour of every day, stablecoins have become a foundational layer of global finance, providing the underlying infrastructure for the modern economy.